Hello, I am Edmond Jamna, and on behalf of DW Consult, I want to introduce to you Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, and shaky base in accounting to an expert position and to a place of confidence. It is also a platform to stay abreast in all matters of accounting. Tutorials on the Go is also designed to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as any tertiary accounting discipline. All that is required of you is to subscribe to our channel on YouTube at DW Consult and click on the notification bell to be part of it. Also, like and share the videos by way of inviting others to come aboard. Tutorials on the Go, bringing accounting to heart. Now, today's episode's lecture. Depreciation. As long-term physical assets get used in the operation of a business to generate income, they lose value, either through wear and tear, through the passage of time, or through the invention of newer technologies. The loss in value must be catered for in the period in which the benefit was derived in fulfillment of the machine concept of accounting, as they were used in the generation of its revenue. So we'll talk about the definition of a depreciation. We want to talk about tangible non-current assets, useful lifespan, residual value, accumulated depreciation, current value, and last but not the least, the methods of depreciation. We'll discuss the other topics of depreciation in a later video, but that's what we are going to focus on in this lecture. Let's move straight into business. Now, what is a depreciation? So depreciation is the method or mechanism where the cost of a tangible non-current asset is charged or spread over its useful life. So it is literally segregating an asset and allocating it over an estimated number of years business deems to derive benefit from the asset. It is a measure of the cost of economic benefit of a tangible non-current asset that has been consumed during the period. Okay, so in simple terms, depreciation reflects the cost of using a physical non-current asset in a business. Depreciation may arise from usage, that is, using an asset to generate income for the business. Physical wear and tear, that is, physical breakdown or deterioration. Passing of time, for example, a 10-year lease on a property. Obsolescence, that's through technology and market changes. For example, a plant and machinery of a specialized nature. Okay, so if there's a new technology, the asset will be deemed to have been depreciated. Depletion, that is, a quarry holding a mineral. So we extract the mineral from the quarry, it is being depreciated. The moment all the minerals are extracted from the quarry, it is fully depreciated. Okay, so depreciation may be prorated or charged fully in the period, but that lies in the full purview of the business. I will elaborate on this later in the lecture. Let's look at an illustration. Now, the purchase of a machinery for $10,000 is an expense of running the business, just as a rent, electricity, and others. So if the machinery is supposed to last for 5 years, it will be inappropriate to expense the $10,000 in one particular year in the income statement and none in the other years. Okay, so it will be prudent to reflect the fact that the machinery is being used in the business over the 5 years and charge an expense for each of the 5 years. So the machinery costing $10,000 being used for 5 years. We are going to charge $2,000 for each of the 5 years. So the $2,000 that we charge annually to score the depreciation. Again, we'll expatiate more on it as we move on. Let's talk about some technologies that we have in depreciation to brighten our understanding. The first we'll talk about is tangible non-current assets. As we have already discussed on assets in our lecture on financial reporting, we learned that assets are categorized into non-current and current assets. Now, non-current assets are further categorized into tangible, which have physical properties, and intangible, which do not have physical properties. So depreciation relates only to tangible non-current assets. Let's look at the characteristics of what tangible non-current assets. The first of it is that they are long-term in nature. That is, they usually last more than a year. They are not normally acquired for resale. Now, even though they might be sold later in the year, the purpose for bringing it into the business is to help in running the business. That is to generate revenue, but not to sell it to make revenue or to make profit. Okay. Thirdly, it is used to generate income directly or indirectly. Directly might be factory machines or operational machines. Indirectly may be office machines or a building that is being rented to generate income for the business. They are not normally liquid assets. So when we say an asset is liquid, it means that it can easily be converted into cash. But Non-current asset tangible are not normally liquid. It means that it is not easily or quickly converted to cash. If you easily convert it to cash, there's a high likelihood that you're going to lose a significant value of the asset. Then last but not the least, it's a capital expenditure. The purchase of a non-current asset is not oftenly seen. It's normally a one-time purchase. The next of the terminology we'll talk about is the useful lifespan. It's the estimated number of years a business intends to use the asset. Okay, so the useful lifespan does not necessarily equal the physical life of the asset. So for instance, a laptop having a 3-year useful life simply means that it will serve the needs of the business for that period, but does not necessarily mean it will exist or last for 3 years only. Now, it may have the 3-year lifespan because the business is likely to replace the laptop after that period due to technological advancement. Residual value. This is also known as a scrap value. It is the value of the asset after its useful lifespan. That is, after it has been fully depreciated. That is what the business will at least expect to receive when disposing of the asset. Now, useful life and residual value should be reviewed at the end of each year and change if expectations differ from previous estimates. Now, depreciation are based on assumptions. The business assumes that the asset will give them economic benefits for a certain period. So if those assumptions differ, then the useful lifespan and the residual value must be amended to move along with the changing assumptions. Okay. Let's talk about accumulated depreciation. Now, this is the total of all the annual depreciation that has been charged for the asset to a particular period. Carrying value, also known as net book value, it is the original cost of the asset less its accumulated depreciation. So this is what is usually recorded in the statement of financial position. We move on to talk about the methods of depreciation. We have 2 methods. The first is straight line method. So with the straight line method, an equal amount is charged as depreciation each year. Here, we deem it that the asset will be used equally in each of the years in its useful lifespan. So the formula for it is that it is the original cost of the asset less the residual value divided by the estimated useful life, or a depreciation percentage that has been estimated by the business times its original cost. This formula will work the same for each of the years. Let's look at an example. Lizzie has a year end of 31st December each year. Now on 1st July 2018, Lizzie purchases a car for $17,000. Now the car is expected to last for 5 years and to have a scrap value of $2,000 required. Calculate the depreciation charge for each of the first 3 accounting periods. Now, the year ends on 31st December. It means it to begin on 1st January. Now, if the asset was bought on 1st July 2018, by the time we are preparing the financial statement on 31st December 2018, the asset will be with the business for only 6 months. So, as we said earlier, the depreciation can only be for the 6 months. That is proration that we talked about. Or a business can decide to charge for the whole year. Let's move to talk about the solution. So the formula, as we talked about earlier, is that the original cost less the residual value divided by the estimated useful life, or depreciation percentage times the original cost. Okay, so let's first look at the 2018. The original cost was $17,000. The residual was $2,000. So we subtract the 2,000 from the 17,000, divide by the number of years, which is 5 years. Now we multiply it by 6 over 12. So 17 minus 2,000 will give us 15,000 divided by 5 times 6 over 12 will give us $1,500. So in the year 2019, the assets stay with the business for the full 12 months. So it's just the 17,000 minus the 2,000 divided by 5,000 times 12 over 12. So 15,000 divided by 5,000 is 3,000. So the depreciation charge for 2019 is $3,000. We come to the 2020. The assets stay with the business for the whole year. So we still charge it the same as 2019, getting $3,000. Let's go talk about the second method of depreciation. In the second method, depreciation charge reduces progressively with time. So here, more depreciation is charged in the earlier years. The notion is that the asset is used more in its earlier years than in the later years. So the depreciation charge here is expressed as a percentage of the carrying value or the net book value. So the formula will be that the depreciation percentage times the carrying value. Okay. So let's note something here. Depreciation method should be reviewed as well at each year and changed if the method used no longer reflects the pattern of the use of the asset. Okay, so a business might estimate that per my activity, straight line method will work for me. But in the course of the usage of the asset, if you realize that the straight line method doesn't reflect the usage of the asset, we have to change it to the reducing balance. Let's look at an example for the reducing balance method. Zoa Limited has a year end again to 31st December each year. Now, on 5th April 2018, he purchased the machine for $20,000. His depreciation policy is to charge 20% reducing balance with full year's charge in the year of purchase. So here we are not doing proration, we are doing full year. So requirement, you have to calculate the depreciation charge for each of the first 3 accounting periods. So let's take a look at the solution. The formula again is the depreciation percentage, which is 20% here, times the current value. So in the 2018, the first year, it was brought into the business. So the cost of the assets will be the same as its current value. So 2018, it will be 20,000 times 20%, giving us $4,000. When we come to 2019, the current value will now be the 20,000 less the depreciation in the previous year, which is 4,000. So it will be 16,000 times 20%, giving us $3,200. When we move on to 2020, the current value now will be 20,000 less the 4,000 in 2018, less the 3,200 in 2019. Then the net will be multiplied by 20%. It will give us what? $2,560. So you see, we have gotten differing values under both methods. So this is where we're going to bring our lecture to an end. If you have any question that needs to be addressed, kindly drop them in the comment section below. We'll also entreat you to subscribe by clicking on the subscribe button and click on the notification bell as well. So we'll come again next time. We'll sign off. Stay blessed. Poker.